This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. The Planet MicroCap Showcase Vegas is happening April 30 through May 2nd, 2024 at the Paris Hotel and Casino in Las Vegas. We announced additional keynotes and speakers, as well as our initial presenting companies for our event. I got to say, I'm just so freaking excited about everything that we got going on this year, from the first ever Allocators Power Hour brought to you by our friends over at Sum Zero. We got the keynotes with Andrew Walker, host of Yet Another Value podcast, with legendary small microcap investor Bob Rabati. We just signed on Josh Young from Bison Interest as well to do a keynote presentation, as well as an allocators roundtable hosted by Acuitas Investments. I'm beyond excited. I just hope to see y'all there. I mean, this event brings together the best investors and thought leaders in microcap, quality microcap investing opportunities, and above all else, the most fun and highest return on your time that you could ask for. There's more announcements to come. This isn't even it yet. But registration is now open. So if you'd like to register to participate, please visit planetmicrocapshowcase.com. See you in Vegas. Now, my guest on the show today is Brian Bears, founder, portfolio manager, and research analyst at Bears Capital Management. I had the opportunity to meet Brian at Ian Cassel's MicroCapClub Leadership Summit last year in Chicago, where he participated in a Q&A with Connor Haley and Ian. Brian has an incredible background and vast amount of experience, not just investing in small microcaps, but also building a small microcap strategy from scratch. In our conversation today, we talk about what it takes to launch a small microcap strategy, how that process has changed in the last 25 years, and how to differentiate yourself in order to stand out in a crowded field of talented investors. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my interview with Brian Bears. Brian, thank you so much for joining me today. How are you doing?
Happy to be here. Thanks for inviting me, Robert.
Absolutely. I'm very thankful for you to be here. You know, we met originally at Ian Cassel's MicroCapClub Leadership Summit back in October. Thank you, Ian. Shout out. And I heard you did a great Q&A with Connor. Ian was hosting that, but you guys did a really great Q&A. And I was just thankful you said yes, because I kind of asked you in passing at like 1 a.m. at the bar when we were all going up. I was like, hey, Brian, like, let's, come to the pod. You're like, yeah, man, cool. Let's do it. So I appreciate you being really cool and saying yes to being on here and sharing some insights.
My origins are in microcap, and so I've always had a soft spot for everybody that's making a go of it in the space. So happy to be here.
We appreciate your appreciation of our nerdom. So we appreciate that. So, I have I have a couple different topics I wanted to talk with you about today, and I had them all prepared. I watched a couple of your interviews, to prepare and everything. But then right before we hit record, I think you just came up with the topic that I was kind of blown away by, that we hadn't really covered on here before, despite interviewing multiple managers, asking founding stories and whatnot. And that's really the idea of building a small microcap strategy from scratch. And especially in 2024, where you have a universe of microcaps that's shrinking, the idea of how we define microcaps has changed now, where, I think most of us now say it's 500 million in market cap or less, so I thought that was a really interesting kind of angle to take it. So before we kind of get to the nitty gritty, for those that don't know you, maybe they've seen your presentations, whatnot over the years, but haven't heard the full background. How'd you get your start in microcaps and then eventually to founding Bears Capital?
Yeah, sure. So I started my career shortly after graduating from the University of Nebraska. I grew up in Omaha, went to Nebraska on a math scholarship, and studied math and actuarial science. Got compound interest pounded into my head, deriving the annuity formulas and so forth, and all the the advanced math behind that. I was a Buffett geek in high school, and so I was reading the Berkshire Hathaway annual reports, and all through college was investing my PA and doing all the things that a beginning investor does, and making all the mistakes that they typically make. And when I graduated, I had some actuarial offers, but I knew my passion was just in common stock picking, and I wanted to make that a career. I had, for personal reasons, moved to Austin, Texas in 1996, and immediately went out searching for firms and funds that were doing what I wanted to do, and talked my way into a job with a small cap manager here in Austin, and sort of started a 3.5-year apprenticeship in the business of institutional investment management. And so they had a 40 Act fund business. They had a third-party marketer that was raising money, and they started to have some success in the kind of .com era. I started at the bottom doing compliance. I built the trading desk, and then got my CFA and started doing some portfolio work. I launched a mutual fund, and really got what I thought was kind of a PhD in the investment business, which in retrospect I had contemplated before taking that job. Just sort of starting a Buffett style partnership and running money myself, trying to get friends and family to give me capital and to be off to the races. But correctly, in retrospect, I think decided to work in industry for a number of years. And I would just recommend anybody that's listening that has contemplating a career, that was really, really helpful to me to understand what it's like to professionally manage money, what the sort of kind of implicit and explicit rules are around it. That there is you need to have a businessman's mindset around the business of running money, and to the investment portfolio structuring, idea generation, conviction weighting, all that is one piece of this. But another big piece of success in our industry is understanding what it's like to build a business, to select the type of clients that you want to partner with you long term, what those clients' implicit and explicit needs are, what they what they want to see from you, what the suitability is, what the rules are around managing that money. And so I was very fortunate to have a very generous boss who lavished responsibility on me and trusted me to help him build his business. The back end of the .com era was not kind to that firm, and I sort of saw the writing on the wall and had some of my own ideas about how money should be managed, both in terms of the portfolio construction, but also the firm structure. And the seminal event in that time period was me reading the David Swensen book, Pioneering Portfolio Management. And David Swensen, at the time, he's now passed away, but was the very successful manager of the Yale Endowment. And he articulated what was essentially at the time called the Yale model, and as now called the endowment model, which is essentially a multi-asset class implementation where the 60-40 stocks, bonds, portfolios started to change, and the pie chart got much more numerous in terms of the slices. The public equity book shrunk from that 60% stocks to something way less than 60%, but the constitution of the managers within that wedge started to change as well, and opened up essentially a new set of institutional allocations to more concentrated managers. And I was contemplating at the time that I left my old firm that this 100 stock portfolios didn't make any sense for institutional investors, because let's say you had 10 investment managers, each holding 100 stocks, you were getting passive results, but paying active fees for the privilege. And that didn't make any sense to me on a look-through basis. And I thought sort of naturally, with the kind of Buffett reading and stuff, gravitating to a more concentrated portfolio was key. It also so happened that our old firm, and despite my math background, was teaching me that a purely quantitative approach to investing did not sort of make sense to me as I walked through the sort of Bayesian analysis of how to structure a portfolio properly. Everything about a business is in its past, but everything that determines the value of a business is in the future. And the future discounting of cash flows to today is really a predictive art, and is more of a qualitative exercise than it is a purely quantitative one. Mm-hmm. And so my old firm being mostly a quant firm, I sort of said, well, what if I can marry this qualitative approach to selecting investments with a concentrated portfolio? Would there be an institutional audience for this? And that Swensen book sort of was the light bulb for me that said, oh, this is the way the institutional world is going. And so I was very fortunate to be in the portfolios of a couple prominent endowments and foundations in the early part of Bears Capital's inception. And I sort of took a 10 stock microcap strategy shopping. And to my surprise, at 27 years old and, no real track record to speak of, that I, got, a fairly, I got a few doors closed in my face, but I also, got a few people interested, and finally a couple people to invest. And that was a very successful strategy for a really long time, and that was sort of the snowball that started our firm. In 2008, we launched a small cap strategy. In 2014, we launched a mid-large strategy, and then recently have sort of merged our small micro portfolios together coincident with the launch of a 40 Act fund. And so today we manage about $3 billion across the firm. And we have 10 people on our research team, and 3 people in sort of ops, compliance, and trading. No sales and marketing people. It's a research boutique, and we operate out of a single office here in Austin, Texas. And our people are on the road in rental cars and racking up hotel points, going in, doing the difficult work of trying to find qualitative exceptionalism in smaller companies.
Very cool. Thank you for the full background. And I think there's a lot we can derive from that, especially with this idea of, building your small microcap strategy from scratch. So I want to go back to when you were 27 years old and you're out there marketing this 10 microcap stock strategy to potential endowments, other institutions and whatnot. When you were originally thinking about the strategy itself, and conceptualizing and then wanting to go out there and pitching it to these investors, it wasn't just saying, okay, here's my strategy for, picking these 10 stocks. Here's all my criteria, blah, blah, blah. I mean, it was also around the structure of how that strategy would actually be executed. Can you get into the details of that a little bit?
Yeah, sure. So, we, at that time, probably the most interesting parts of my story when I tell it to people have to do with, well, how did you get the money, right? Like, I mean, that's the hard part, right? If that were easy, that we
let's just cut to the chase.
Microcap money. Yeah. But 10 stock microcap was highly differentiated at the time. I mean, there was, I remember running around going, I think I'm a unicorn. There's nobody else doing a 10 stock microcap strategy back in 2000. And lo and behold, as I went and knocked on doors and talked to people about this, I did come across one or two others. And so it wasn't a total unicorn, but let's just say that the competitive set was very, very small. And so if anyone was looking for this, there weren't a lot of options. And my calculus was really around, Goldman or some large company or a large asset manager, if they were trying to replicate what I'm doing, they would have to close their strategy to new investment at very low levels of AUM, and the profitability is just, it's not even what a middle manager makes at Goldman Sachs. And for me, if I raised $130 million in microcap money and we charged 1.25% flat with no carry and it was a separate account strategy. At that time, that the math on that, it seems like a pittance to somebody in Midtown Manhattan was, allowing me to do what I love to do here in Austin, Texas.
I was going to say, in Austin, you live at large, man.
In the late 90s, I mean, I thought I died and gone to heaven. And so, this was, just a perfect setup for me. And I think institutions at the time loved the sort of scarce access to these types of managers that was just becoming a thing. It's like, and for better, for worse, at that time, there was less scrutiny around operational due diligence that was pre-Madoff and all these other things. And so they were a little bit more, candidly, apt to invest with a newer manager back then. I think, that still exists today for people doing off the run, interesting things. But, I think the operational scrutiny is just a little bit higher, and the hurdle is a little bit higher today. There also was a flood of new sort of hedge fundy type managers that were hitting around the late 90s and the early 2000s. And so, I was sort of, straddling these due diligence people at these allocators where it was like, well, maybe they're alts and hedge fund people would sort of sit in on the meeting because, highly concentrated microcap strategy sort of felt like that. But then the public people would be in there as well. But if we started getting into these conversations about, Sortino ratios and, what's your median PE and things like that, I was like, I'm probably talking to the wrong people. I'm looking at these as businesses. I want to hold these businesses for a long time. I think these are future compounders. And if I found kindred spirits on the other side of the table at these endowments, and which was not always the case, I knew we could at least have a intelligent conversation about what we would look like. It is really, really hard to find investor one from scratch. And so I had to knock on a fair number of doors to and get a little bit of help to get into some offices of people that I thought could actually write that first check. But once we got it, then the snowball, like that institutional, like social proof was there, and the snowball started rolling a little bit. So,
how do you think about, at that time, how much do you equate luck versus good quality? Like, just, I mean, your timing couldn't have been better, right?
Yep,
In many
100%.
respects, because nowadays, I mean, look, I mean, hey, this is episode almost 300 of Planet MicroCap Podcast. I've interviewed, a number of folks that have a microcap or even now a smicro strategy, multiple times, and there's many more that I still haven't interviewed over the years. So, I mean, at that time, there just wasn't a lot of those strategies that could help that gave some of these folks this exposure, right?
Yep.
So do you feel like there was a bit of luck and timing involved versus now, when, not saying everybody and their mother has a small microcap strategy, but it's definitely, and it's also more difficult even to get them off the ground.
Yeah. So I would be remiss if I didn't, acknowledge good fortune in my background. I mean, it's just like, I'll give myself credit for identifying that the institutional allocator landscape was changing and positioning and working very, very hard to position us to be a recipient of that sort of gradual allocation to concentrated managers from more diversified managers. And so there was maybe one stroke of smarts in there, but the good fortune was manifold. I mean, we were on the back end of a dot-com implosion. I was finding in that original microcap portfolio, I own names like Utah Medical Products that was trading at 8 times free cash flow, 30% returns on capital, no debt, and a sort of owner operator at the helm. I owned a company that did radiation monitoring badges called Landauer. It was like a 7% current dividend yield, which was half their free cash flow. And it was 30% returns on capital, debt free, and a duopoly globally. And it was just like, these were lying in the street at the time. And so it was a very fortunate time to, put a flag in the ground, because there was, everyone was still focused on the globe.net and outpost.com and these names that were, the sort of post.com implosion names. And so it just so happened that the valuations were very attractive at that time. And that initial portfolio, had performed very well. Although the first 4 months of our composite performance, we were down 22%. And so, I mean, that's not a very encouraging start for a manager. But, the concentration, unfortunately invites volatility, and that volatility can be sometimes embarrassing. And I, have gone through many periods in my career where that, is an optical nightmare for us. And so, that was a good first step, I guess, in that journey.
What would you say is the biggest difference between launching a small microcap strategy from scratch, late 90s, early 2000s, compared to today?
Well, on top of the operational due diligence, you just need to be a little bit more sophisticated about your platform, how you're doing it, the compliance around it, the ops, all that sort of stuff. One thing that was fortunate in my background is that at my old firm, I actually did a lot of that stuff. Like, I read the Investment Advisors Act of 1940, cover to cover. Like, I actually just went through and read it. And our firm, and the first handful of employees, I'm like, this is just a good exercise. It's like, why would you play Monopoly without reading the rule book, right? It's just like, you ought to know what the rules of the game are. It's like, what are your reporting requirements? What do you have to have on a trade sheet when you actually execute a stock? What are you supposed to do? And so I was, had been through an SEC audit at my old firm and all this stuff. It's like, I understood the ecosystem and the operating environment. And so I think we were a step ahead of like my peers that were starting at the time, because I had that in my background. Today, that's pretty much table stakes. And there are a lot of third-party, consultants and people that can help you through all that sort of stuff. But the scrutiny is just a little bit higher. Like, if we have institutional due diligence done upon us, it's like, all right, show us your trade procedures, like show us your compliance manual, your code of ethics, all these sorts of things. And, that in our early days when we were getting institutional scrutiny, they weren't diving into our operations like they would today. So, maybe the barrier to entry is a little bit higher today on the ops side, but still it's not like starting a manufacturing facility. I mean, the barriers to entry in our business are very, very low, which leads to the second point, which is there are just a lot more people competing in our space than when I started. Professional competition in small micro is ramped up pretty significantly. The number of opportunities is actually smaller. So when I started, the top of the ninth decile in the CRISP database, the Center for Research and Securities Prices, which I think has the best data for U.S. stocks going back to 1926, the top position in the ninth decile was like 175 million in market cap. Today that's more like 600-700 million in market cap. There were also like 3,500 companies in that bottom 20% when I started, and today that number is probably more like 1,700 or something like that. I haven't checked recently, but certainly the universe has shrunk. Now the good news is that the playing field is largely, with Dodd-Frank and all these other regulatory structures that have come into the space, into the public company space, the shrinkage has mostly come from the bottom. When I started, like, there were $5 million market cap companies, right? I mean, because you could stay public because it wasn't very expensive to be public. And today it's much more expensive and the regulatory regime is much bigger. Private equity is a bigger piece. I'm sure you've talked about this in your podcast many times. But the functional universe isn't really that much different, despite the number shrinking pretty considerably. We sort of look at the space and say, how do we define microcap these days? And we run small micro, so we look at the breakpoint of the Russell 2 and how many companies are on limits to us, and it's about 1,750 companies that are really in our investable universe within small micro. And those companies actually, like, there are significant swaths of the universe that are either uninteresting or off limits to us, where there's 1 in 7 stocks roughly as a regional bank or thrift. And while those have, fine returns on, equity, they're not exceptional. And we're looking for exceptional. And they're also difficult to understand. They're black boxes. There's a lot of risk to those businesses. And so we usually, just discard those from our research database. 7% of the companies are commodities and energy. That's a macro bet usually. And we're not any smarter, despite being in Texas, on where oil's going tomorrow. And so we typically don't spend a lot of time there. An increasing portion of the universe from when I started is biotech. And so it's like 26% of the universe today, of our universe. And, we're not PhDs in chemistry or whatever. So we don't have this, view on whether a drug can get through FDA, and, this binary outcome type of idea is something that we would typically discard as well. We like the reagent businesses, the pick and shovel businesses, those types of companies, but that's a big swath of our universe that's pretty much off limits. And so that leaves about 1,200, 1,300 companies that are really investable for us within small micro. And so that actually isn't that much different than when I started. Those numbers are, despite the size of the universe, like, the functionally on limits businesses are still pretty numerous and interesting to us. What's different today is it's more picked over. There's more professional competition. However, our strategy is actually qualitative in its approach. That is, we're trying to find exceptionalism and moat management growth that would lead to high internal compounding of business value, that over time, neutralizing for dividends and distributions and multiple expansions and contractions, would lead to exceptional stock price performance. The convergence of underlying business value compounding and stock price, we believe, for the long-term investor will happen. And therefore, above average stock price performance comes from above average business compounding. And so that qualitative search feels pretty similar today to what it did back then. It's just that we've been doing it now for almost 24 years, and it took us about 8 years to get through the microcap space, like, one by one. And so today, if you started a microcap strategy, like, the seductive thing is to just say, well, I'm going to throw all of these quantitative tools at this that weren't available when I started, right? And so I'm just going to do a bunch of quantitative sorting and filtering, and I'm going to screen on low PE and low price to book and low EV to EBITDA and try and find cheap in the market, and then maybe I'll use some qualitative judgment and build a strategy. Whereas, when I started, there were people that were actually doing that, But my contention was that the market's getting more efficient over time, even in small microcap. And a low PE, a low price to book, a low EV to EBITDA is more and more likely to be an indication of a business that's under earning on its capital base, and that the blended consensus of investor action is actually assigning a low multiple deservedly to these companies, rather than being like in the 1980s and 90s when I was sort of studying this stuff originally. Kind of low PE reliably worked as a contrarian indicator of cheapness, right? And my heroes of yesteryear that were the sort of Buffett 2.0 crowd that managed mutual funds successfully and so forth, pretty reliably produced outperformance by just buying low PE contrarian stocks. Well, surprise, surprise, the market gets more efficient, and through competitive action in the marketplace, like that strategy just stopped working. And I think it's very interesting that Fama French, from the three-factor model, the low price to book factor in the three-factor model that worked for 80 years just stopped working in 2000. And I think it's just this, large data sets, quantitative. If there's an opportunity for quantitative arbitrage where there's a factor that's working for some period of time, it's like a lot of capital gets, thrown at this stuff, and its utility gets nullified in the marketplace. And so that painstaking qualitative underwriting of all these microcap companies for 8 years actually has become what I think is kind of a competitive advantage for Bears Capital, right? It's very difficult to hand select out of 1,200 on limits companies, like the very best ones, and to distill over time and sort rank over time these non-quantifiable qualitative factors of company excellence that should lead to above average business compounding. So I think all of that's available today. The challenge is you got to get some resources, and the chicken and egg problem of scaling to have the capital to be able to resource a 10-person team or whatever size team to attack this problem effectively. So that's kind of a huge word salad here over the last 5 minutes, but a little bit differential between.
That was not a 5-minute word salad. That was. I think if anything, I should probably clip that on its own for people to hear, because you pretty much distilled in a nutshell, I think, what every single microcap investor has been thinking probably for the last 25 years is that here. You just outlined probably the main way folks should be starting to think about microcaps as beyond just, what the traditional metrics for cheapness have been, because like you said, it has become more efficient. We're like, amongst most of us, when we're at the conferences, we talk about the shrinking universe and how it's just become so expensive to be public and all that. But in some ways, that's making this universe even more efficient, because there is a lot of riffraff at the bottom rung of these that,
Yep.
They might have real businesses, sure, and there's ones that do have real businesses, but are more growthy stage. Yeah, they're losing money, but they're growing. They need the growth capital, whatever. But there is a lot of riffraff that is just perpetually raising capital that will never have a real business, right?
Well, you bring up a really good point too that is worth, I'm sure your investor or your listeners know this, but this point is worth always repeating, which is, I wrote a book in 2011 that, articulated 2% advantage that, the bottom 20% of companies have in terms of performance over the top 20%. That is, small micro beats mid large by roughly 2% per annum since 1926. I haven't updated those numbers internally, in a while, and I imagine Mag 7 has had an impact on that. And there's probably like a little
last
bit
3
of
years
of that gap.
Last 3 years have been interesting.
But for 90 years plus, like that was a pretty reliable 2% advantage for and I think it's worth bringing up what you said, that there's a lot of riffraff in the space, and it was performing better than mid large. Despite having that riffraff in the universe, and despite having this problem of reverse survivorship bias where the successful companies leave the universe. And so the reason I'm bringing that up is that actually in small micro, selectivity is really important. Not only do you get the categorical advantage, but if you can just avoid a few landmines within your selection process, and if you just make a simple accommodation, which we have, which is, hey, just because something exits the universe doesn't mean we're automatically going to sell it and subject our strategy and our investors to reverse survivorship bias. We're going to hang on to these companies if they continue to grow. I think can meaningfully improve your odds of success by being a small microcap investor. And so it's not an easy place to outperform because performance is just getting harder all around because there's so much professional participation. But it is a space that just intuitively you want to participate in, and intuitively you should add value through active management.
Well, I would say even, I mean, yes, it's a hard job regardless. Investing is hard, but I'd say like if you're still looking in the sub 100 million market cap, you still have such an advantage because the professional money isn't the good majority of the professional money is just not there.
Yep.
But as an active, sophisticated retail manager, or somebody that's really digging their teeth into just managing their own portfolios, you've such a clear advantage, and I don't think that'll ever go away.
Well, and the other advantage that's a little bit newer compared to when I started is like, there is a lot of money like flowing into multi-manager, multi-strat pod shops where basically, the industry phrase that money is flowing into the short end of the alpha curve, which the grossing up and grossing down of position sizes as a result of the risk management models of these pod shops is causing an enormous amount of volatility just around near-term earnings, which is a problem for managers like us that have investors that are looking at, quarterly performance and wondering why there's these huge swings in variability in performance and that sort of thing. But it's a huge advantage for somebody that can, candidly just tune out the noise and invest for the long term. If more money's, flying to the short end of the alpha curve, like those of us that are focused on a multi-year horizon should have the opportunity to do better. It just might be a rockier ride.
By the way, why did you end up launching the 40 Act Fund? I remember in the Q&A with you, Connor, and Ian, you were like, "I know when I wrote my book, I was never going to launch one, but here I am.
Yeah.
I did it, And it seems like, I mean, it seems like you kind of already answered that question a little bit there in wanting to have an option for concentration for, I mean, I think the minimum investment is 10 grand, right, just to get in it.
Yep.
So curious as
Yep.
to why did you ultimately decide to open it up?
Yeah, so we were approached to manage essentially on a sub-advisory relationship, a private bank 40 Act fund. And we found that it's a perfect marriage of our small microcap strategies. The requirements for diversification, even for a non-diversified 40 Act mutual fund, they're they're a little bit greater than what we have managed in our institutional separate accounts. And so, but in small microcap, it's okay because you have more sort of single industry companies that, aren't quite as big and geographically dispersed and so forth. And so having a few more positions in small micro, I think achieves a better overall diversification picture while still maintaining a fairly concentrated posture, 20, 25 names in the 40 Act fund. And so we like the managing the single account. We had never had an avenue for people who over the last 20 years were interested in investing with us because we've always been an institutional investment manager. And so I was also getting, this is sort of how the sausage is made, but we have an internal policy that says, we have to prefer our clients' money over our personal money. And so if we're buying or selling for institutional clients, I'm sitting here with my personal money, not able to perfectly sync my capital with theirs. And with a 40 Act fund, I can just be a co-investor in the fund and get the same exposure. I'm the largest investor by far in BCSMX, so the alignment is perfectly, I think is a perfect alignment with our investors. And I just thought there was a lot to like about it, and I thought, in an era where everyone's starting limited partnerships and everyone wants to launch a hedge fund, the regulatory regime around the 40 Act fund is more expensive. It is more complex. It is kind of a pain in the ass, candidly. But if we offer it on a direct basis, we can have a partnership feel, and people can, hop on our website and they can open up an account with 10 grand or more in states that were registered, and please read all the disclosures, and this is an offer, and so so forth and so on. But it's a new distribution avenue for us to reach a population that heretofore wanted to invest with us that now can't. And candidly, it allows the principals of this firm to invest alongside of our clients in a way that really wasn't available with institutional separate accounts. And having a transfer agent sort of deal with the shareholder paperwork and interactions and stuff like that is also kind of helpful, rather than having these direct institutional quality relationships where we're constantly, talking, and we like managing money, and we love our institutional relationships. They're great, but this is a kind of a way of allowing people that were interested in us to co-invest with what we're doing in small micro. So
very, very cool. Cool. So not to jump back and forth, but now I wanted to go back to the building small microcap strategy from scratch. Let's say you didn't have Bears capital today. Let's say you had to take a step back and you were like, all right, I just let's just say you retired from another career and you said, all right, I want to get into professional investing today, and I want to do it via a small microcap strategy. I want to start it from scratch, and I need to go out and raise that initial capital. In your opinion, how would you construct that small microcap strategy that you think will successfully garner interest from institutional allocators today?
Yeah. So the question's two-pronged. The first is, how do you structure the strategy itself to set yourself up for the best investment success? And then it's actually three-pronged. And then secondly, how do you connect with people that are interested in what you're doing and get people to help fund your effort by being co-investors in your strategy? And then candidly, how do you marry the two appropriately? And so, the short answer to your question is, I think what we're doing right now in small microcap, like my wife told me the other day, she's like, I haven't seen you work this hard since you were 27. And I'm really enjoying this process in small micro and mid large these days, because the market's very interesting. It's very volatile around the short end of the alpha curve. There's, actually a fairly significant disparity still, despite a run up in Q4 in valuation, like the high, the Mag 7 or whatever is trading at, I don't know the exact number right now, 29 times earnings, something like that. I think S&P without Mag 7 is like 20. And then, mid caps are 16, small caps are 14, micro caps are 13, forward PEs or something like that. Like, I'm starting to see, kind of Q2, Q3 of last year, I was starting to see stuff that wasn't quite as cheap as the examples I gave back in 2000 of Landauer Utah Medical Products, but like I'm starting to see stuff that has those echoes. That is like we're finding more to do than we certainly did from that 2014 to 2021 period, where it just sort of felt like you were paying pretty full market multiples, and you kind of had to bet a little bit more on duration to grow into the multiples that you were paying in the market. And so it's pretty, it's much more exciting to be an investor today. But the short answer again is, I would set things up basically like we're doing right now. So I wouldn't really change anything. There's some legacy muscle motion of Bears Capital that's sort of hard to shake, but 95% of what we do today is what I would do from scratch if I were starting today with my own money. The important thing on the investment side to remember is that if you're building a strategy and you're looking to attract investment and you're looking to succeed, you need to have a repeatable investment edge, right? And you need to be able to articulate that to people. And so an exercise that I think is very valuable is to, have an investor sit down and say, what is my edge? What is it about me that like can outperform? Because if you're just thinking that you're smarter than everybody else, I got news for you. This is a business that's filled with incredibly bright people, and the consensus is probably going to be smarter than you most of the time. And so
not only smart people, but smart people that also are wrong.
That's right. That's right.
Yeah.
But it's like it's like the old it's like the old marble game about estimating how many marbles are in a jar in a classroom full of people. No one person's right, but everybody's right, And so, it's beating the consensus is very, very difficult repeatedly over time. And so you'd be able to, especially if you're, in the room with an institutional investor, you need to be able to articulate that edge. I just had a Zoom call the other day with a guy that's runs a biotech focused. He's an MD, Johns Hopkins MD, and a very, very smart investor with a business background. But is marrying that specialized knowledge to just have a very focused, biotech focused fund. And I'm like, that's a very clean example, I think, of where you can sort of make the good case that, hey, like we know what we're doing in this space and not a lot of people do. And, there's a very high probability that we could create an investment edge in this. And also as I've illustrated before, with 26% of the space being biotech, it's like, that's the opportunity set is fairly numerous. And so there is an opportunity to put up numbers repeatedly in that space. For us, it's really the qualitative moat around our business and the painstaking, selectivity that we've applied to this numerous space. And so that sort of forms our investment edge and is a moat around Bear's Capital. So I would start on the investment side by saying, what's my edge, and trying to build my edge. Maybe I'm an industrials focused person. Maybe I have some unique insight. Maybe I've got some unique qualitative recipe or quantitative recipe. But if you can, sort of show that in a slide or two to an institutional investor and convince them that you indeed have an edge, then you will vastly improve your odds for raising money and executing properly. And so, I think it's marrying those two things. It's like having a good process and that leads to good outcomes, and then being able to candidly interact with people that are looking for that. The sales side of this, the marketing side, the raising money side, is really about understanding what institutions are looking for, and you can't get to that understanding without talking to them. Sure, listening to some podcasts and things like that, but actually going into the office of an endowment or a foundation or a bank or an insurance company or a consulting firm and just saying, this is what we're doing, and then hearing the feedback. And the feedback is often like, hey, look, we wouldn't invest in a biotech focused fund for these reasons. We don't have an allocation for that, or what we're really looking for is infrastructure. That's or we're looking at multi-manager, which is popular these days because, the ride is a little smoother, and candidly, we got stung in 2022 or whatever. You'll hear this feedback and you'll sort of see where the allocations are going. And if your strategy, it may be producing good results, but if there's no allocations available for that, you sort of can't be, you can't change their investment map, their allocation, their, what's on their calendar for the year, what they're looking at and underwriting. And so, there's a lot of wasted motion in trying to raise institutional capital. It's really about being in the right place at the time those allocations are available, and being one of a handful of managers that they'll do due diligence on, and hopefully you check all their boxes and make it through, and then finally are awarded the account. Now in raising money from family offices, raising money from high net worth individuals, that's a little bit different, right? There is a little bit different of an art. It's harder to find those people. I would argue sometimes that's a better avenue, because a relationship to relationship person, you're not going to have a series of people turning over in the allocator jobs over time. If you're managing a high net worth person's money, it's just a very simple relationship. There's managing 40 Act funds like we do, and that's a little bit different story. People have to know about them and how to buy them, and availability, like getting on Schwab is actually a very expensive proposition for funds these days. Like they're paying for shelf space at these various brokers. That's a tough game to be in, and the financial barriers to entry are actually a bit higher. So, there's a number of ways of approaching all of this, and marrying it together is the important thing, is making sure that you're getting the right types of investors for your strategy. Because the death nail is trying to raise money from somebody where it's just not suitable for the strategy that you're running. You always got to keep that suitability thing in mind too. We're not, and we say this in our fund marketing docs, we don't want to be more than a sort of single digit-ish percentage of somebody's portfolio. I don't think it's appropriate or suitable for us to be, 50% of somebody's money in small microcap. And so we want to be sized accordingly within a broader asset allocation. And I think that's really important to know who you are, because I don't have to be, right about long, short, about, different parts of the capital structure, about Europe or Asia or whatever. It's just we're tasked for U.S. small micro, and that's where we focus our time and energy. And so that's it's kind of nice to be able to just define your own sandbox, play in it, and then hopefully that fits in someone else's puzzle as well. So.
Absolutely. Well, I'm going to scratch out my question to ask you about Australian microcaps. That was my next one. No, but
I love Australia. I studied abroad there in college.
Oh, yeah. It's the best. I'm recording an Aussie MicroCaps pod a little bit later this week to
cool.
kind of get an update as to what's going on down there. I'll save that joke for a later date. But you know what?
Okay.
One other thing I wanted to get to ask you about here today too, and this has to do with what you're looking for amongst your the 1,300 companies in your functional universe, and that has to do with sustainable competitive advantage. And I was curious from your perspective, what does that really look like to you now in 2024? Because it clearly has changed in the last 20 years.
Yeah. I think most people would agree that what's called the topple rate, the rate at which companies are leaving the index, is actually increasing, which means that there's a technological risk of obsolescence that's greater, which again, could be an opportunity for active management by being a little bit more selective. That competitive advantage period that you could sort of reliably say was, some multi-decade period might not really look like that today in an age where things are getting rendered obsolete very quickly. But the important thing to remember is that like the reason that we're looking for, these qualitative buckets are that, the average company is going to earn its cost of capital. That is, if I've got a shop selling widgets at the corner of, Main Street and First Street, and I'm earning supernormal returns, you're going to open up shop across the street and you're going to compete away the excess returns that I'm earning. It's sort of microeconomic theory 101. And so everybody ends up, earning their cost of capital over the cycle. And there's I forget the name of the author, but somebody in a book said about competitive advantage. In the end, everything's a toaster, and I love that quote. I'll have to look up who said it, but I repeat that often because that's it. Every business has some competitive advantage, period, and then it ends up being rendered a commodity, and sort of the economic supernormal returns disappear. And so, for us, it's about understanding the qualitative aspects of the competitive advantage, the people running it, the confidence that we have in their allocating the excess profits back to us as outside passive minority shareholders, their ability to innovate and continue to stay ahead of competition, their ability to execute and win in a competitive marketplace. And then finally, the growth qualitative bucket's important too. Like, do you have the ability to internally reinvest these supernormal profits at high rates? Or is there perhaps an external pathway to capital allocation that, through M&A, despite having, 80% of acquisitions failing to meet their intended synergy targets, there is a subset of 20% of these companies that do really well at acquisition, the Danahers of the world, the Berkshires, and so forth. And if we can, underwrite the team and the strategy that executes on these plans, there's a real, advantage to us in terms of variant perception, but also, allows them to continue these competitive advantage periods longer than would, otherwise be intuitive. And so, it's just about studying these qualitative factors as deeply as we can. In the traditional sort of competitive advantage moat bucket, we're obviously looking at Porter's five forces. We're looking at, a lot of information services and technology companies where you have competitive lock-in, you have switching costs, you have network effects, these types of things. And so we have to stay close to this and monitor them. And if we feel like competitive deterioration is happening, we're active managers, and despite our preference for holding businesses for a really long period of time, we have no problem decisively moving out of positions if that qualitative thesis starts deteriorating. But I think the general sort of direction of your question is correct. That is, like, it's harder to assess the long-term nature of competitive advantage today than it was 20 years ago and 20 years prior, and that the technological threats are rising on pretty much every front.
Not just the technological threats, but their larger cap competitors.
Yeah.
They're just continuing to scoop up whatever market share. Every one of these companies can talk about TAM all day, but when 93.8% of it is already taken up by two or three of their largest competitors, it's like, okay, good luck. Go. Unless you're trying to create a whole new market, but then that comes with its own separate issues, right? As well.
Yep.
So, you've answered all my questions here today, and you have so much quality insight that, like, I want to almost like save some meat for a later conversation, because I'm sure you'll come back on. We'll jam on some more things.
Yeah.
But I figured my final question that I'll ask for you here today, and that is this evolution of valuation. right?
Mhm.
We talked about how, back in the 80s, that, you could just find some, stocks based on, low PE stocks, and, more often than not, throw a dart and probably be all right, construct a
Mhm.
portfolio from there. You talked about how that's evolved in the 2000s as the market's getting more efficient. As we move ahead here in 2024, when you think about valuation for small microcap companies, how do you envision those various valuation metrics to continue to change?
Well, I think there's something evergreen, which is that, the value of any business is the sum of future cash flows that it can
Sure.
produce.
Yes.
And I think with the volatility around earnings that you're seeing today, that the opportunity exists to be very patient, very selective in names that you've pre-qualified, that you have a high degree of confidence in the potential outcomes, kind of waiting for, market pessimism and disconnects between price and value. And so the sort of fundamentals are still in place, but I would argue that, the market is reasonably efficient even in the smaller end. And that, I love our starting hypothesis, which is always that if something looks cheap, there's probably a reason for it. Right. And we just have to go find that reason. So that starting hypothesis is a low PE is not an indication of contrarian investment value. It's probably an indication of a business that's under earning on its capital base. And so that was true in the early 2000s, and that's pretty much true today. And so we're more apt to pay what may look to an outsider like an optically more full valuation for a business that we have high degree of confidence that the internal compounding potential is very high, and that it would grow into that valuation and make that starting valuation look very cheap with the benefit of a long time horizon. And so that's the way that I think I still think that is not, pervasively, that approach is not pervasively incorporated into all of these quantitative managers' sort of actions in the marketplace. That is to say, like, there's a lot of people that are looking at low PE, low price to book, and dedicating lots and lots of resources to to competing away those inefficiencies in the marketplace, even in small microcap. And so you just have to be, I think, better at predicting the future of these businesses. And you don't want to overpay for any of these companies in terms of a starting multiple, but you want to be patient and not be afraid to, like the best business are probably not going to trade at an 8 PE, right? I mean, it's probably not going to happen. Sometimes it does, but it's probably not going to happen. And so you have to be, just a little bit better at the understanding where the future cash flows are going to come from. And, you have to be able to distill the exceptional future path from the average one, and note that paying an average multiple for an exceptional future path is probably going to turn out well.
Well, unless it's just very illiquid, right? Maybe
Yeah.
maybe
Yeah.
you'll find some low
Well,
PE stuff. Yeah.
and running $10 million is different than running $100 million in that regard, right? I mean, there
Oh,
are
100%.
off the run OTC type names that are really great, that are candidly even off limits for us because they're just too illiquid, and that's an opportunity, and has been, for the individual investor. And I said this recently, but after really thinking about what it is that I love about this business, I think it is that same sort of dopamine snack that you get in your brain when when you're fishing and you get a bite on the line, right? It's like the discovery value of sort of flipping the pages of the microcap space, and with the thought that the next one could be the next Microsoft, like that sort of hope, that discovery value, that sort of triggers the treasure hunt mentality in my brain, is like what keeps me coming back, and why I fell in love with the game in the first place, and why I still continue to work hard on behalf of our investors, because I would do this for free because I love the hunt. And so I don't know if others have the same. Yeah, I think some people are in this business because they just want to increase their personal balance sheet, get rich, whatever. Like, it was really never about that for me. It was never about maximizing the economics, feeling like I'm an adversary to my clients, whatever. I've always wanted to be a good deal for our clients in terms of the fees that we charge. I always, wanted to feel like real partners with them, just to enable me to continue to do what I like doing, right? And so this, sort of discovery value is what keeps me coming back. And we've caught a few of these long-term compounders that started in MicroCap. And then I, have the torture of waking up every day and seeing lots of names that we identified that we never bought that, are now multi-billion-dollar market caps that were once microcaps. And, that torture is pervasive. So
100%. Well, I think that is by far the best place to end our conversation here today. As I'd love to continue to have another one soon, but man, you just put such a nice bow on that. So Brian, where can our audience go and find more information on Bears Capital Management and get in touch with your team?
Yeah. Just go to our website, bearscapital.com. And that's got links to everything. Institutional investors obviously can make overtures that way. There's links to our fund website, and that's it. So we don't have any sales and marketing people, so we're a research boutique. If there's people interested in what we're doing, just reach out to us directly. So
very cool. Well, Brian, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
Thanks, Robert. It was fun. Take care.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.